My guest is Dan Walkow from Bank Capital, and he is an absolute specialist in cross-border investing. In particular, what we were going to talk about tonight is California.
California, it's a very timely subject, David. I think when I brought the subject up last week and mentioned to you we should get on it, your eyes lit up, because there's so much to talk about in regards to California, because it is certainly different than most other states in the United States in regards to taxation. Am I correct?
Well, it's the only state, for instance, that taxes the internal earnings on an RRSP.
Let's describe that. I think it's confusing for a lot of people.
Oh, we got another phone.
Reckon?
Can we take another phone
call?
Sure,
let's go for a call.
We have a call from a person who has moved to Afghanistan and wants to declare non-residency, but wants to invest in a condo in Calgary. One moment.
Not brought.
You're in Afghanistan.
Hello?
Hello, you're in Afghanistan?
Yes.
Okay.
No, I'm currently back on vacation.
Okay, but you want to move to Afghanistan, or you are living in Afghanistan? I'm lost.
I've already moved there, but I'm currently on vacation, and I'm back in Calgary, just tying up some loose ends.
Okay, well, and Richard said that you wanted to buy a condominium in Calgary.
Yes, that's correct. Basically, my question, I have two questions, but I'll just ask
Okay,
one.
ask the questions then.
If there's time, then maybe you can answer the other one. So the first question I have is, basically, CMH, I can't put 20% down on my investment property. CMHC, therefore, comes into the question in order to insure my mortgage. They charge much higher rates in order for an investment property as a primary versus a primary residence. So I'm wondering, and I actually did buy an hour of your time, Dave, and it was very useful. Thank you. And you made some very good recommendations with regard to declaring non-residency. I'm just wondering, is a mortgage with CMHC something that Revenue Canada would actually look into? Should I actually pay the higher fees for an investment rental income that they will insure the mortgage on, or can I tell them it's a primary residence, therefore pay the lower CMHC insurance rates on my mortgage, and save myself some money there because Revenue Canada would never look into that, or should I keep it consistent?
Well, in my book, and I make it very clear, the banking documents get you every time. I can think of a Royal Bank, I can think of the Bank of Montreal, and I think of Bank of Nova Scotia documents that were used to make people residents of Canada. So you don't want to declare yourself as a principal residence, because it isn't a principal residence. If you're buying it to rent out, the only way you can remain a non-resident is if you rent it out on a non-arm's length, an arm's length. It's got to be somebody you don't know, not a friend, not a relative, not a brother, etc. And you should be using a rental agent if you do that, so that it is clearly past arm's length. If you and I can't recommend that you declare it as a principal residence, because in reality that would be a fraudulent statement.
Right. Okay.
Does that make sense?
Yes, absolutely.
Okay.
It does.
What was your other question?
My other question was, I have a possibility. One of the investment properties I've looked at, if you pay $10,000 extra on top of the sale price, they've got the full furniture package. I know that I've sold all my furniture that I owned.
If it's a rental package to rent it out, that's fine.
If it's a package to rent it out,
absolutely,
okay.
Doesn't matter.
Okay, perfect. Because
Okay.
I know you'd mentioned that furniture is a big thing.
No, but that's not your furniture. You haven't ever slept in that bed, and you haven't do. But what I want you to make absolutely sure is that you don't use this apartment yourself.
Okay.
Never, ever, ever, ever. If it happens to be in an apartment hotel type of thing that you could go and stay in your own unit, there's nothing else you do, don't do it.
Now, if I move back to Canada in 6 years, could I use it then? Or
absolutely. You can move. When you move into it, you have a deemed disposition. It becomes taxable to you at that time, but under Section 45(3) of the Tax Act, you can elect to defer the taxation until you actually sell it on the capital gain. Okay. If you've depreciated it, you have to pay tax on the depreciation.
Okay, perfect. But as an investment property, buying the package of furniture is not a problem?
No, absolutely not.
Okay. Thank you
Okay.
so much, Dave.
Now, that's the same as if you were moving to California,
Right.
or moving to Saudi Arabia, or moving to Hong Kong, or moving anywhere else. Same kind of thing happens.